why passive funds or the reasons to invest in a passive fund.
Core of passive is that you co-own winners and losers because you don't know who will do what. Like I said, economic growth is good. Where is the economic growth going to come from in the next 3 years? Which sectors are likely to grow faster versus slower?
Hi guys, I'm Kriti and I'm a Gen Z, more like a curious Gen Z. While we are curious about a lot of things, finance is sort of the elephant in the room. And that is why today I'm in conversation with Mr. Rahul Singh, the Chief Investment Officer's Equities at Tata Mutual Fund, and Mr. Anand Varadarajan, the Business Head at Tata Mutual Fund. Thank you for being here. And I am curious about investing and about finance, but I'm very confused to where to start. I mean, मैं videos देखती हूँ, reels देखती हूँ, but I don't know whom to trust, whom to not trust. So that is why, while finance in general interests me, but passive investing is something that I am really curious to know more about. So would you help me understand what are passive funds?
Okay, so let me ask you this, that if you have, so you passed out recently, so assuming there are 50 students in your batch, and I give you this option that you get any one person's earnings, whatever they make, you get their earnings, or the other option is I'll give you whatever the average earnings of the entire class, you get that. Which one do you choose?
I think the average earning, because I mean, you don't know which person to bet on, right?
Sure. So basically what you will end up doing is, because you don't know who will really make it big, there is a possibility that you bet on that individual, turns out that someone else did, and you end up losing your earnings. So it is better that you end up betting on the average. And passive investing is a bit like that, where you are rid of having to take that call of who will be the best in your class. You just bet on the class because you are very sure that what the class will do will be a combination of those who made it really big and those who didn't make it all that big. And if you bet on the average, then you will somewhere stay closer to the mean line rather than having to live with this burden, if it will, of what if you happen to bet on someone who didn't do all that well. And what passive investing does is now replace that batch of 50 with Nifty 50, and there are 50 stocks that you have in the Nifty. So you end up betting on that Nifty 50 index instead of you having to pick which stock in Nifty 50 will do well.
Oh, there are so many reels out there, it just gets really confusing. This analogy really helps. And this way, I don't even have to track how each person is doing individually because the average takes care of it.
Precisely.
So let's venture more into this, and if you can explain why passive funds or the reasons to invest in a passive fund, especially as a youngster, but in general also.
Have you watched a parade, Kruti?
Yes.
Live?
Yes.
Okay, what happens in a parade when the band is playing and coming, and suppose one person stands up to get a better view of the parade, then what happens immediately after, over a period?
It's just chaos. Nobody really gets the view. At the end, it's the same.
Yeah, everyone tries to look over each other and everyone gets an average view. So, and it becomes the same as what it was when all of them were seated. Similarly, in an index, also what happens is that, when you start looking for picking up the winners, everyone starts quickly copying that, and over a period of time, everyone gets the average return. So what becomes supreme is the index catches up with that outlier, and just like everyone stood up, you will find that, like for instance, let me give you an example. If there is stock A, which has done very well in a particular portfolio, then everyone will know that this stock has performed well. So everyone starts buying it in the portfolio. Then what happens to the stock returns? It becomes average because everyone's caught up with it. And over a period of time, that advantage is gone, just like the parade example. If you were to look at what has happened over a period of time, Nifty has now been around for a very long period of time. Nifty has seen a lot of changes. So there are new stocks which come into this Nifty 50, and old stocks which have not been able to keep pace with the market have gone out of Nifty 50. So what is constant is Nifty 50 has been there, but what is not constant is the stocks which could not
Comprises.
hold on to the their position in top 50 stocks. They got wiped out of Nifty 50. They fell off Nifty 50, let me put it this way. So over a period of the last 20-24 years, there are only 13 stocks which have survived, which were there then and which are there now. Whereas there have been total Nifty 50 has seen 150 stocks, ins and outs put together. So it just tells you that death is the rule, survival is the exception. And that is why you are better off holding a Nifty 50 than trying to second guess which stock will do well.
Just to add to what Anand said, from a fundamental level, if the economy is doing well, which is what India is today, and you have different sectors, different kind of companies doing well, then, if you are in a passive fund, you are getting advantage of that at an average level of the economic growth. And because also typically the passive funds will have the larger companies and the winners, as Anand was saying. So in that kind of economic scenario where macros are good, companies are doing well, and India is overall GDP growth rate, etc., is at a faster pace, growing at a faster pace than the rest of the world, then a passive fund ensures that you at least get the full benefit of that growth without having to worry about picking, X sector versus Y sector or X stock versus Y stock.
Just so that why passive, I'll give you a few more examples which will perhaps help you think about it differently. Suppose it takes you 40 minutes to come to office today, right?
Yeah.
And suppose there is a new flyover which has come, right? You took that flyover the day it opened. You came in 25 minutes. Then everyone starts taking it. Then what happens? The new average becomes 35, because then it becomes a crowded thing and everyone knows it will explode, and everyone starts taking that, and eventually your average time drops for sure, but you don't have that kind of saving which you had when you were the first one on the flyover or the only one on the flyover.
Yeah.
Think about it, and this happens in everything. So if you were to look at, there was an interesting study which I read about, where 100 years, 1912 or 15, I don't remember very well, marathoners then, who used to run 42 kilometers, used to take a little over 4 hours. And the gap between the winner and the 20th rank guy would be about 30-40 minutes. So by the time the first guy would have taken a shower, had his, this thing and so on, the 20th rank guy would come and finish. Today, if you look at it, I think the marathon record is, I forget the name of the gentleman, but it is under 2 hours. And the gap between the first and the 20th person is not 40 minutes. It's much, much smaller. Yeah. So over a period of time, what happens is that overall efficiency itself increases, and that's what, by efficiency, I mean the index itself becomes far more efficient, the pack of 50 becomes far more efficient, and the gap between the best performer and the last performer also reduces. So that's another way to think about passive.
Yeah, and this is of course the most important aspect of passive investing, but I was also reading about it a bit and also watched it somewhere, but they tend to have a lower expense ratio and they are sort of less volatile or something. So someone who is just starting out right now, who doesn't really understand it or gets it, I think passive funds is a good way to foray into the investments in general. Am I right?
That's correct. I mean, as I said, if you want to make sure that you are at least participating in the growth story which India is, then passives give you that opportunity. And it's a very clear opportunity without, as that previous analogy which we were referring to, without having to individually track the performance of each sector or each stock. And that's the, beauty of passive funds.
If you were to look at, let's deal with an example here. If EVs, for instance, are picking up in a big way, I mean, it's in its nascency. A lot of manufacturers in the auto sector are getting into EVs, electric vehicles. Now, it'll be very difficult today to pick who will be the winner in EVs. But if you don't know who will be the winner, and you have to make a bet on it, what's the second best thing you can do? I mean, you can't be wrong. I mean, the winners have to be from somewhere within the auto companies. One of these guys would win. So bet on the entire pack rather than trying to bet on one company.
Right. Again, the point of like track, you don't have to track individually, rather like because average takes care of it.
That's right.
Yeah. So while we are at it, I have like few more questions. So what is the difference between active funds and passive funds? I really don't get it because I'm just like starting to understand investments. So if you can help me understand that better.
Yeah. So active funds try to take bets based on either short-term or long-term thought process on which stocks or sectors or managements are likely to do better than the average, right? So while passive is a great way to capture the average growth without having to worry too much about disruption in the economy or disruption like EV is a disruption, right? What active funds try to do is to try and understand in depth the sectors, industries, as well as management quality, as well as the previous track record, and try and predict whether they can make that extra return as compared to that average. Now, this involves, for example, if the economy, like I said, economic growth is good, where is the economic growth going to come from in the next 3 years? Which sectors are likely to grow faster versus slower? And if one can be right in that more often than not, then the chances are that you will make that extra return over the benchmark or over the passive funds in general. So active fund, and it depends a lot on obviously the skills of the fund manager and the investment philosophy, are trying to generate a situation or maintain a portfolio which does better than the average. In a way, you can say that it is trying to predict which route will be the shortest. And if the flyover is getting crowded, then should we go back to the previous route and do that consistently over a period of 3 to 5 to 7 years.
I also want to understand like more about the different types of passive funds. If you can shed some light on it. Yeah.
There are multiple types of passives. One is that of market cap based, which is you buy the top 50 companies, top 100 companies. So you buy large caps, mid caps, small caps, and so on, which are market cap based. Simply put, size of the companies based investing. The other would be thematic or sectors, which is like I mentioned earlier about auto could be one sector, real estate could be another, pharma could be one, and so on, which are buying into particular sectors. The third could be something like the core of passive is that you co-own winners and losers because you don't know who will do what, and hence you buy the whole. Now, if you were to think about what you add to it, you add some slivers of strategies whereby you try and eliminate some part of it, or you try and add some slivers which add some return, but at an index level. These are called, in very complex words, it's called smart beta funds. But very simply put, suppose value as a theme. Value is something which is, say, buying something cheap. Value as a theme is doing good. You go and buy a value index fund. there is momentum which is doing very well, which is some stocks have come into momentum and these stocks are doing very well. So a momentum index will try and capture some of those aspects of the market. So these are theme based, which also allow you to play some of these kind of sub themes which are prevalent in the market. So you have these broad three categories to choose from as far as passives are concerned.
So that helps, but I have been reading a bit about index funds. So while I know that index funds are a type of passive funds, but I'm sure there are like other types also. Would you please share a little more detail on it?
So yeah, broadly index funds and exchange traded funds, ETFs as they are called. ETFs is like watching a full live match, ball by ball. So what an ETF does is it gives you NAVs throughout the day. Index fund will give you end of day. It's like highlights. So end of day NAV is what you would get. So if you invest, end of the day your money will get invested at the at a particular valuation. Whereas if markets opened lower and closed higher, and if you had invested at the lowest point in the ETF, you would have captured that day's return end of day when you look at it. So it's like investing in live prices versus investing in end of day.
I understand finance, investment and passive investment a bit better, and I'm sure a lot of questions that especially people my generation had were answered because of this. So thank you so much for your time.
Thank you, Kruti. Pleasure.
So that was Mr. Anand Varadarajan and Mr. Rahul Singh sharing their insights on passive investing and passive funds for people like us to understand it better. Thank you for joining us today and see you until next time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.